You elected S corporation tax status because you heard it could potentially save you money on taxes. But here's something that doesn't get talked about nearly enough. Making the S corporation election is the easy part. Operating your S corporation correctly after the election is where many business owners get into trouble. Because you can't simply elect S corporation status and then continue running your business exactly the same way you did before. So today, let's talk about 7 common S corporation mistakes and how to avoid them. I'm an enrolled agent with over 14 years of experience helping business owners navigate taxes, accounting, and IRS rules. Let's talk about it. Over the last few videos, we've talked about how S corporation owners pay themselves. We've talked about how S corporations can potentially save taxes. And we've talked about reasonable compensation. Now, let's bring everything together. Let's go back to Jane. Jane owns a growing home care agency. She elects S corporation tax status. She's excited about the potential tax savings, but now she actually has to operate the S corporation correctly. And that's where our first mistake begins. Mistake number 1, making the election and changing nothing else. Jane makes her S corporation election and then nothing changes. She continues transferring money to herself wherever she wants. She doesn't establish payroll. She doesn't change how owner transactions are recorded. She doesn't understand the difference between wages, distributions, and reimbursements. And she assumes making the election by itself created the tax savings. That's a major misunderstanding. The election is only the beginning. Once your S corporation election becomes effective, additional tax, payroll, accounting, and filing requirements come with that election. Your S corporation generally files its own federal income tax return on Form 1120-S. If you work in the business, reasonable compensation becomes important. Payroll becomes important. How money moves between you and the business becomes important. And accurate accounting becomes even more important. An S corporation isn't simply something you elect on paper. The way you operate the business has to follow the election. Mistake number 2. Taking distributions without properly paying yourself W-2 wages. Let's say Jane's home care agency is profitable. During the year, she transfers $70,000 from the business to herself. She calls all $70,000 shareholder distributions. But Jane works full-time in the agency. She manages caregivers, she meets with clients, she oversees daily operations, but she never runs payroll for herself. That's a problem. Remember our 2 hats? Jane wears her employee hat because she performs services for the S corporation, and she wears her owner hat because she owns the S corporation. Her employee hat receives W-2 wages. Her owner hat may receive shareholder distributions. You don't simply ignore the employee hat because distributions receive different tax treatment. The IRS expects shareholder employees who perform services for the business to receive reasonable compensation before taking non-wage distributions. So before asking, how much can I take in distributions? First ask, am I properly compensating myself for the work I'm performing? Mistake number 3, choosing your salary based on a rule of thumb. Jane realizes she needs payroll. Great. Then she hears about 60-40 rule or a 50-50 rule, or she simply chooses the smallest salary she thinks she can justify. We've already learned why that's not the right approach. There isn't one universal IRS percentage for reasonable compensation. The IRS looks at the facts and circumstances. What does Jane actually do? How much time does she spend doing it? What responsibilities does she have? What training and experience does she bring? And what would Jane have to pay someone to replace the work she performs in the business? Remember our replacement question. If Jane stepped away tomorrow, what would it cost the business to replace the work she performs? That's a much better starting point. The goal isn't to find the lowest salary possible. The goal is to arrive at a reasonable, supportable salary based on the work you're actually performing. Mistake number 4. Treating every payment to the owner the same way. This is where good accounting becomes extremely important. Not every dollar moving from Jane's S Corporation to Jane personally represents the same thing. Jane receives a paycheck, that's payroll. She receives money because she's an owner. That may be a shareholder distribution. Jane personally pays a legitimate business expense and the S Corporation properly reimburses her. That's different again. And here's another example many S Corporation owners don't know about. If the S Corporation pays or reimburses health insurance premiums for a shareholder who owns more than 2%, special W-2 reporting rules apply. So simply looking at money leaving the business account isn't enough. You have to ask, why did this money move? Because the answer helps determine how the transaction should be treated. Mistake number 5, taking distributions without understanding basis. Here is one we haven't talked much about yet. A shareholder distribution isn't automatically tax-free just because you call it a distribution. Your ability to receive an S Corporation distribution without recognizing taxable gain generally depends on your stock basis. Think of stock basis very simply as a running measure of your tax investment in the S Corporation. Money or property you contribute can affect your basis. Your share of business income can affect your basis. Losses can affect it, and distributions can affect it. If your distributions exceed your available stock basis, some of that distribution may become taxable. We don't need to calculate basis today, but I want you to remember this. A distribution isn't automatically payroll tax-free. That's another reason accurate accounting and tax records matter. Mistake number 6, letting the accounting get messy. Now, imagine Jane's business checking account. Client payments are coming in. Caregiver payroll is going out. Insurance, software, rent, Jane's W-2 payroll, shareholder distribution, business reimbursements, maybe owner contributions, maybe loan payments. Now, imagine none of that is being accounted for correctly. The end of the year arrives. Jane sends everything to her tax professional and says, "Can you figure this out?" That's not where you want to be. Your S Corporation tax return is built from your accounting. Your payroll needs to reconcile. Your distributions need to be tracked. Your shareholder basis needs accurate information. Your business expenses need to be properly categorized, and your balance sheet needs to make sense. This is why I keep saying good tax planning starts with good accounting. An S corporation doesn't make good accounting less important. It makes it more important. Mistake number 7, forgetting S corporation has its own tax deadline. Here's a very common mistake. Your individual Form 1040 is generally due April 15th, but a calendar year S corporation return is generally due March 15th. That's 1 month earlier. And that's easy for a new S corporation owner to miss. Your S corporation generally files Form 1120S. Then each shareholder receives a Schedule K1 containing information they'll generally need for their individual tax return. So once you become an S corporation owner, you now have another tax filing deadline to manage. Before we finish, here is one professional tip that brings this entire S corporation conversation full circle. Don't assume that because an S corporation can potentially save taxes, it automatically saves you money. You have to consider the entire picture. Potential payroll tax savings, reasonable compensation, payroll tax filings, accounting, tax preparation, potential state and tax fees, and the additional compliance required to operate the S corporation correctly. Suppose your home care agency produces $50,000 of annual net profit after ordinary business expenses. If reasonable compensation for the work you're performing consumes most of that profit, and then you add payroll, tax preparation, accounting, and other compliance costs, the potential tax savings may not justify the additional complexity. But as your agency grows and the business produces substantially more profit than reasonable compensation and the additional costs, the calculation can look very different. That's why the question isn't simply, do S corporations save taxes? We already know they potentially can. The better question is, will an S corporation save enough money in my particular business to justify the additional cost and complexity? That's a much better business question. If you remember just one thing from today's video, remember this: electing S corporation status is the easy part. Operating it correctly is where the real work begins. Run payroll correctly, pay yourself reasonable compensation, understand your distributions and the reimbursements correctly, maintain accurate accounting, know your filing deadlines, and make sure the potential tax benefit actually outweighs the additional cost and complexity, because the goal isn't simply to have an S corporation. The goal is to operate one correctly. And with that, we've now covered how single owner LLC generally pay themselves, how partners generally pay themselves, how S corporation owners pay themselves, how S corporations can potentially save taxes, how reasonable compensation works, and now 7 S corporation mistakes you want to avoid. In our next video, we're going to step back and put everything together. We'll answer the bigger question: which business structure is right for you? I'll see you there.